Hey everyone, welcome back to the channel where we break down markets without the hype or fear-mongering. If you're new here, hit subscribe and turn on notifications, because what I'm sharing today could change how you think about your portfolio for the rest of 2026. Today we're diving into the biggest financial story of early 2026, the brutal crashes in Bitcoin and gold. Bitcoin dropped nearly 50% from its October 2025 peak, falling below 64,000 after hitting 126,000. Gold, after smashing records above $5,600 per ounce, corrected sharply to around $4,800. Silver collapsed over 30% in a single session, its worst day since 1980. But here's what I need you to understand. This is not the end. This is a reset. I'll prove it with data from JPMorgan, BlackRock, and insights from Michael Saylor, Paul Tudor Jones, and Dalio. Stick until the end for recovery timelines, price predictions, and why smart money sees massive opportunity here.
The psychology of crashes.
Before diving into specifics, understand what happens psychologically during crashes. When Bitcoin drops 50%, our brain's fear center hijacks rational thinking. This triggers panic selling and doom predictions everywhere. Howard Marks, founder of Oaktree Capital managing over $170 billion, says the biggest mistake investors make is selling at the bottom because they can't stand the pain anymore. Dalio of Bridgewater, the world's largest hedge fund, emphasizes, the times when it feels worst to invest are often when expected returns are highest. The math is simple, but the psychology is hard. Keep this in mind as we examine the carnage together. Bitcoin's plunge from 126,000 to below 64,000 wasn't random. It was a perfect storm, creating what analysts call a full-blown crypto winter. Matt Hougan, chief investment officer at Bitwise, described it as necessary cleansing of the market, telling Bloomberg the late 2025 euphoria created unsustainable conditions. Here are the key factors. Risk-off sentiment. Bitcoin got caught in broader speculative asset sell-offs. Barry Bannister at Stifel noted credit stress indicators reached levels not seen since 2022. When credit tightens, speculative assets get hit first and hardest. Leverage apocalypse. When Bitcoin broke 70,000, over $1.4 billion in leveraged longs were liquidated in 24 hours. This created a vicious cycle. Forced selling drove prices lower, triggering more liquidations. Over $8 billion in long positions were wiped during January's sell-off.
Digital gold narrative.
While gold surged 24% from October through January, Bitcoin fell 50%. When investors sought safety, they chose actual gold. Michael Burry suggested Bitcoin bulls were selling gold to cover crypto losses. Macro pressures. Geopolitical uncertainty, from Trump's tariffs, tensions with Iran, a slowing labor market, and sticky inflation all fueled risk aversion. Then came the bombshell, Trump's nomination of Kevin Warsh as Fed chair. Deutsche Bank called this the single most important catalyst for the sell-off. Warsh's hawkish reputation signaled fewer rate cuts ahead. Whale selling. On-chain data showed large holders moving Bitcoin to exchanges, indicating preparation to sell. Forbes warned of a potential death spiral if prices hit 50,000, risking minor bankruptcies. Tech correlation. Bitcoin traded like Amazon on steroids. Nasdaq dropped, crypto collapsed harder. Global liquidity drying up hit volatile assets first. Current price sits around 64,885. The Fear and Greed Index hit extreme fear at 11 points. Historically, that's been a buying signal, not selling.
Why gold crashed?
Gold's crash was equally shocking. After rallying 65% in 2025 and breaking above 5,600, it plunged 9 to 11% in a single session. Silver crashed 30 to 36%, its worst day since 1980. Combined, they erased approximately $7 trillion in value. The Warsh shock. Trump's January 30th nomination of Kevin Warsh flipped sentiment overnight. Warsh's hawkish reputation meant fewer rate cuts, strengthening the dollar and making metals pricier for foreign buyers. A 65% yearly gain for gold and 150% for silver was extreme. Too many traders piled into the same trade. When selling started, profit-taking snowballed. Exchanges hiked margins, forcing more selling from leveraged traders. Peter Schiff actually warned about this in December 2025. saying the rally was getting into overbought territory and a pullback would be healthy. Dollar strength. The dollar spiked post-nomination, making gold more expensive for international buyers. Central banks in China and India temporarily paused buying. Geopolitical de-escalation. Temporary easing in tensions with Iran, Venezuela, and other hotspots reduced safe haven demand. Leverage unwind. Similar to Bitcoin, gold and silver markets experienced severe leverage unwinding. Jeffrey Christian of CPM Group described it as a liquidity rupture from extreme positioning meeting limited market depth. Gold currently trades around 4,862, having recovered about 1.75% from lows. Proof. This is an over bullish signals. Now the part you've been waiting for. This is a reset, not the end. Here's the evidence from the biggest names in finance. For Bitkersters die Information. JPMorgan notes, Bitcoin's volatility relative to gold hit record lows at a 1.5 ratio, making it more attractive long-term. If Bitcoin matched gold's private investment of approximately 8 trillion on a volatility-adjusted basis, it implies a price of $266,000. Network fundamentals remain solid. Hash rate is stable, no mass capitulation. Bitcoin held on exchanges continues declining, showing long-term holders moving to cold storage rather than selling. The institutional infrastructure isn't going anywhere. BlackRock's IBIT ETF holds tens of billions in Bitcoin. Larry Fink, BlackRock CEO managing over $10 trillion, wrote, "We believe Bitcoin represents a fundamental innovation in finance. We expect adoption to grow significantly." Historical patterns show every major Bitcoin cycle included 30 to 50% corrections, all of which became buying opportunities in hindsight. Foregoing to make it continues to show. The structural bull case remains intact. Central banks continue buying approximately 800 tons annually, far above historical averages. Geopolitical tensions haven't disappeared. US national debt exceeds 35 trillion and climbing. Despite that crash, JPMorgan raised its year-end 2026 gold target to $6,300. They looked at the crash and concluded gold will be higher by year-end. Gold already recovered approximately 6% from lows. Analysts at Suckden Financial note the quick rebound suggests strong underlying demand at lower prices. Both ING and Deutsche Bank characterized recent moves as volatility within an ongoing bull market, not a trend reversal.
The sharks are saying.
Michael Saylor. Michael's strategy holds over 190,000 Bitcoin. He stated, "Bitcoin is here to stay. These corrections are noise. I'm not thinking about next quarter, I'm thinking about the next century." Paul Tudor Jones, the legendary hedge fund manager, said, "I find Bitcoin very appealing. When I see the money printing, fiscal deficits and geopolitical uncertainty, I want hard assets. Bitcoin offers asymmetric upside gold can't match." Ray Dalio, the Bridgewater founder, recommends holding both. The question isn't whether to own gold or Bitcoin, it's what percentage of your portfolio should be in each. Having exposure to both makes sense. BlackRock. Their research notes stablecoins increasingly challenge traditional fiat currencies, ultimately boosting crypto legitimacy. Client interest in Bitcoin hasn't diminished despite volatility. Recovery timelines and predictions. Bit. Short-term stabilization between 75,000 and 90,000. Potential V-rebound to 80 to 85,000 if 70,000 holds. Mid-2026, possible bottom between 50 and 70,000, followed by sustained rally catalysts include Fed rate cuts and renewed ETF inflows. End of 2026, consensus targets range from 120,000 to 225,000, with midpoint around 143 to 175,000. Key drivers: Fed policy shifts, regulatory progress, ETF flow resumption. Gona. Short-term, recovery toward 5,000. UBS projects 6,200 by March if geopolitical tensions resurface. 2026, average Reuters analyst poll projects $4,746.
Year-end targets range from 5,000 to 6,300 from JPMorgan.
Long-term, Deutsche Bank sees 6,000. JPMorgan floats 8,000 in bullish scenarios.
Key drivers: geopolitical developments, central bank buying patterns, US fiscal concerns.
Prediction.
Here's my synthesis of everything researched for this video. I believe by end of 2026, we'll look back at January and February as one of the decade's best buying opportunities for both Bitcoin and gold. The combination of extreme fear, forced selling, and intact long-term fundamentals is exactly what precedes major rallies. For Bitcoin, I expect year-end prices between 120,000 and 180,000, assuming macro conditions don't deteriorate dramatically. For gold, I believe we'll see prices above 5,500 by year-end, with potential for new all-time highs if geopolitical tensions resurface. But markets are unpredictable. Anyone claiming certainty is lying. I've shown you evidence and analysis from credible sources to help you make informed decisions.
Final thoughts.
There you have it. The crash is explained, proof this is a reset, and recovery timelines ahead. Analysis from JPMorgan, BlackRock, and legends like Saylor, Tudor Jones, and Dalio all point to opportunity in this carnage. Remember, this is education, not financial advice. I'm not telling you what to buy or sell. The smart money sees opportunity here. You should understand why before making portfolio decisions. If you found value here, smash that like button. It helps the algorithm show this to more people who need it. Subscribe and hit notifications for my follow-up video on Bitcoin halving cycles and what historical patterns suggest for the rest of 2026. Drop a comment below. Are you bullish or bearish from here? Have you been buying this dip or waiting? I read every comment. Until next time, stay informed, stay rational, and remember the best investors made fortunes by being greedy when others were fearful. See you in the next one.